Hello, everybody, and welcome to problem 1716. We have Blue Jewelry Company uses gold in the manufacture of its products. Blue anticipated that it will need to purchase 500 ounces of gold in October 2020 for jewelry that will be shipped for the holiday season. However, if the price of gold increases, Blue's cost to produce jewelry will increase, which would reduce its profit margins. So to hedge the risk of increased gold prices, on April 1st, Blue enters into a gold futures contract and designates this futures contract as a cash flow hedge of the anticipated gold purchase. The notional amount of the contract is 500 ounces, and the terms of the contract give Blue the right and obligation to purchase gold at a price of $300 per ounce. The price will be good until the contract expires on October 31st. Assume the following data with respect to the price of the futures contract and the gold inventory purchases. Okay, so for this first one right over here, on April 1st, and just give me one moment. So for letter A, because there's no premium paid on April 1st, it's no fooling. Rather, we're going to be a disclosure to the effect that Lou has the right and obligation to purchase, 500 ounces of gold at $300 per ounce by October 31st, 2020. And you would say that they entered into a contract, and that's how you would kind of show that one. Okay, so on June 30th, we're going to prepare our financial statements. So on June 30th, the price of gold has gone up. So because of this, our futures contract now has value. So what we're going to need to do is we're going to go right over here, is we're going to basically say, okay, the contract price per ounce is at 300. The spot price, gold, at June 30th is at 310. So the increase is going to be over here at $10 per ounce. So right over here, we have our ounces. We have 500 ounces. And so we're going to have an unrealized, we're going to have a gain of $5,000. So over here, my debit is going to be 2 on June 30th, 20. I'm going to debit the futures contract, and this is going to be for $5,000. I'm going to credit over here unrealized holding gain or loss equity. This means that it's not going to go onto the income statement. It's going to be a part of other comprehensive income. Okay, so right over here, the next one is going to be, so I prepare my financial statements. That's the journal entry I would go through and make. Okay. On September 30th, I prepare my financial statements. So over here on 9/30, have the same deal. My contract price per ounce is 300. The spot price for gold is now 315. This is an increase of $15 per share. I have ounces at 500. So my gain unrealized is going to be 7,500. or this is actually a better way to say this, the value of the futures contract. So over here, when I look at my futures contract, the value of my futures contract on June 30th was at 5,000. So I needed this entry over here. And then I had a unrealized holding gain or loss equity. Over here at 5,000, this was for 630. This is also for 630. Okay, when I get to September 30th, the value of this futures contract is now at 7,500. So the entry I need for the adjustment is going to be 2,500. So this is my adjust. Okay. So my entry would essentially kind of follow the same thing right over here. So I'm debiting the futures contract. Let's make this a little bit cleaner. This is going to be for 2,500. I'll make this even more appealing. Perfect. Okay. So that's September 30th. On October 10th, Lou purchases 500 ounces of gold at $315 per ounce and settles the futures contract. So what's going to happen here is that we're going to see over here that we're going to purchase the gold at $315 per ounce. Okay. So I'm going to be crediting cash, purchasing inventory. Over here. Okay. So this is going to be 315 times 500 or 157,500. Be crediting cash. Now, at the same time, they're going to be settling the futures contract. So for this case right over here, I'm going to be crediting the futures contract, right? And what's important here is that this value has not changed. It's still going to be the same at September 30th. So I'm going to credit the futures contract for 7,500. And I'm going to debit cash. Okay, so we're going to take a quick look at this just because it should be kind of fun. Okay, so what is really happening here? So this is to record the purchase of inventory. And this over here is to record settlement of the futures contract. So in effect, what's happening here is that if I'm looking at the net amount of cash I'm paying, so it's really like, okay, I'm paying 157,500, but I'm getting like a rebate of 7,500, so I'm paying 150. And what this really represents is that I've got $300 per ounce price. I'm buying 500 ounces. So it's a total of 150,000. So it's really what I'm going through and doing in terms of with this particular contract. That's why this futures contract is getting me into this. Now, the other kind of interesting thing with this is that as I'm looking at this a little bit more carefully, and I'll have to go back to the PowerPoints and look at it, I think one of the things throughout all these different lectures I've been struggling with is like, okay, if it's an unrealized holding gain or loss, is this going to be something that I include in other comprehensive income or loss, or is it going to be another item on the income statement? What I'm beginning to realize now, at least for this particular situation, is that if I have a futures contract and I'm basically trying to hedge the price of my product, it's not speculation, but this is just purely to go through and to hedge the price, is I'm going to leave this in the unrealized holding gain or loss on equity. And then ultimately, when I sell the gold or when I sell the product, that's when I would go through and recognize it. So at least that's what I think. Sounds good. Okay. So that's letter D. That's October, that's October 10th. Okay. So it's letter D, and then letter E. I sold jewelry containing gold purchased in October 2020 for $350. The cost of the finished goods inventory is $200,000. Okay, so in terms of the letter for letter E, December 20th, 2020. So I have my typical thing here. I basically sell it, get cash, 350,000. I credit sales revenue for 350. I'm then going to debit cost of goods sold. I'm going to credit inventory. Okay. Now, the other thing I also need to do here as well is I need to, now that this inventory has been sold, I'm going to debit the unrealized holding gain or loss on equity over here for 7,500. And this would be my 1220 adjustment. And what I'm going to do is I'm going to be reducing my cost of goods sold. At least that's what I think that I'm going to do based on the prior examples. And let's just see if I'm close here. Yeah. So that's how I'm going to go through and record it. So once I have sold the inventory, then the unrealized holding gain or loss will go against cost of goods sold. Okay. All right. So that's as of December 31st, 2020. Now, if you had to ask me what would be shown on the balance sheet and the income statement related to the futures contract, now, this is a little bit tricky, right? We're going to have on the balance sheet, we would have an asset for the futures contract for 5,000. However, this unrealized holding gain or loss on equity would be shown as, it wouldn't be on the income statement. And in fact, it would, if anywhere, it would be below the income statement. And I'll just pull up for you. Apple is a great company to look at. Okay, and so when we look at Apple, and I'll go to a quarterly report just because it's a little bit quicker to go look. Okay, so if you notice here for Apple, they have net income, and then they have this comprehensive income. And this is where you kind of see this over here, right? And this is really where you put some of the other comprehensive income. Now, what they're correctly stating in the solution is that, you know, I'm debiting the futures contract, and then for here, because this is a fair value hedge, I'm putting this under accumulated other comprehensive income or loss. So that's really what that And in this case, it would be income. So because it's a credit. So that's where, for my income statement, the amount reported on the balance sheet would be 5,000 as an asset for the futures contract. So let's write this out. So I would have over here my futures contract, and then I would have an under owner's equity. For the quarter end, it's 6/30/20. This will be non-applicable. So I would have an unrealized holding gain of 5,000. Okay. So my balance sheet would be showing this. My income statement would be showing this. Now, indicate the amounts reported in the income statement related to the futures contract and the inventory transactions on December 31st. So over here, the income statement here would be showing sales less COGS gives me gross profit. My sales would be 350. My cost of goods sold would be 200,000 less the 7,500. So my gross profit would be 157.5. Now, in terms of this cost of goods sold, my inventory cost was 200,000 less the futures contract. So that's how that cost of goods sold number is coming about. Okay. So that is problem 1716. I look forward to seeing you on the next video. Have a great one.